We're going to talk more about the Moody's threat to downgrade Spain with Gary Jenkins. He's with us by phone from London. He is head of fixed income and the former head of credit research at Evolution Securities. Gary, S&P already has a lower rating or a lower equivalent rating on Spain than Moody's does. So why would everybody be reacting with such concern to Moody's action? And it isn't even really an action because they haven't actually gone ahead and cut Spain's credit rating.
That's true, and they are playing catch-up to the market, and they're certainly playing catch-up to S&P. However, it is negative from a sentiment point of view, and it's not just what they say they might do. I think a lot of it is what they've actually said in the commentary about the potential impact of the savings banks on the rating. So I think there's that, and there's also the situation that we have all kinds of problems in Europe, obviously, with the sovereigns. You have disagreement at the top of the EU. Spain is the line in the sand that really cannot be crossed, just because the amount of debt they've got to raise in 2011. So any negativity surrounding Spain is going to be taken quite hard by the market.
You just mentioned the concerns over the cajas. These are the Spanish savings banks. Would you agree with the rest of Moody's rationale that there's a big refinancing hurdle ahead of Spain next year? Some people estimated it's something like 200 billion euros. And then in addition to that and the cajas, there's this concern over the lack of control that the federal government has over regional governments and their free spending ways.
You can't argue with any of that. It's all factually correct. I think Moody's has hit the nail on the head with the cajas and the lack of control that Spain has centrally with its regions. And the main thing is there's just a lot of problems concerning the amount of debt they actually need to raise, in the sense if we continue to see Spanish 10-year yields rise, then people are going to get more and more concerned and about their ability to actually raise that money.
Gary, a lot of people consider the rating agencies like Moody's to be a lagging indicator, given that Moody's currently rates Spain AA1, its second highest rating. In your opinion, for Moody's to have credibility with the bond market, where would it need to take that rating down to?
I think for Moody's to have credibility with the bond market, they'd have to do a lot more than just take one rating down. But the truth is that it trades, obviously, in the CDS market a lot lower than the
well into junk.
Rating.
We were looking today.
Yeah.
I mean, it's cheaper to insure Lebanese government debt than it is to insure Spanish government debt, and Lebanon is four ratings into junk.
Well, that about sums it up. The rating agencies don't really reflect the reality of the liquidity crisis and the solvency crisis that's evident in the European sovereign space.
All right, Gary, listen, a pleasure to have you here on such short notice. Gary Jenkins of Evolution Securities on the Inside Track.